So the big question is this: how are those in the self-storage industry like us going to be successful in today's market? That's the question, and this show will give you the answers. My name is Jim Ross, and welcome to the Self-Storage Show.
Hi everyone, this is Jim Ross in the Self-Storage Show, and today we're going to continue our Storage Spotlight series. I got Yonah Weiss, he's a cost segregation expert. How's it going?
How you doing, Jim? It's been a pleasure. It's been a long time in the running, but glad we finally got a chance to get on a video chat.
Yeah, no, it works out great. We've been kind of both putting out content and all that kind of stuff. I'm like, I gotta get that guy on, and we tried once, didn't work out, but hey, planets align, so I'm glad you had the time to be able to come on here.
Exactly.
But no, I watch your stuff. I've been seeing your content, talking about cost segregation, and quite frankly, I hear that and I start going, what? But you have a great way of explaining it and just kind of layman's terms. And actually, it seems like not seems you're passionate about it. So that's why I wanted to have you on to, talk about that.
Absolutely.
So first
Absolutely.
off, tell us how'd you get into it in the first place? Kind of a little about yourself and go from there.
Yeah, sure. Just a little bit. I really just been involved in cost segregation, I'd say, for the past 2 years or so, and it really came about really more with the company that I'm working for more than anything else.
Yeah.
I have a passion about real estate, and that came about 5 years ago or so when I started wanting to learn more about real estate. And I have really the source of it all is I have a passion for learning. And so when I find a subject or find something that I want to learn about, and especially when it's something so life-changing, I just dive all in and I soak up everything. And my background is really in teaching. So I was a teacher for about 15 years. And that's where my passion to teach and to give over, topics like this really come in handy.
I was just gonna say that's your ability to be able to explain this kind of thing, and so
exactly.
That makes perfect sense. All right.
Exactly. So involvement in real estate, went from being a broker to I was learning commercial mortgages for a little while, working for a firm doing that, and I got into fix and flip, single family. I just wanted to learn everything there was into real estate. Then I got involved with the company I'm working for now, Madison Commercial Real Estate Services. We have a number of services, but Madison Specs, which is the cost segregation company, is the one I'm working for specifically, and kind of in the business development and teaching and doing tons of these podcasts and really getting the message out there. Because just like you said, when people hear the name cost segregation, first of all, no one really knows what it is. And they're like, oh, it's taxes. Yeah, I'll just leave that to my accountant. Like, please, like people have like a mental block a lot when you talk about taxes, right? So I'm trying to just clear that up and do the best I can to teach people about how they can save money, income tax, like huge, huge, huge amounts. And that's really why I have such a passion for this, because when you can help people, make a difference in their lives, keeping the cash in their pocket, reinvesting it, making, building their wealth, and not just, funding the Federal Reserve, like we got to do our part, right, for ourselves first.
Well, obviously you're on the self-storage show, so
exactly.
Let's weave this into, how does this work for storage owners? What's in it for them trying to save a buck or two like you're talking about here? How does it, I guess, first off, what is cost segregation? And then we'll move into what can they actually do? So.
Right. So first off, cost segregation, and we'll just give a brief background about what it is, how it works, and then I'll tie it right into self-storage, because it has to do not just with self-storage, with any real estate. So any investment property, any property that you own, whether it's a business property or a rental income producing property, so investment, excluding your personal residence. So just have to get that. If you own a home, that's great, wonderful, but this does not apply to you. Okay. So we have a real estate deduction, a tax deduction called depreciation. Okay. And everyone's probably heard of depreciation. It's a tax write-off. It's some people call it a phantom tax. It's just a paper write-off. What that means is you take the value of the building the day that you buy it, okay, the purchase price of the building, you subtract the amount for land, because land does not depreciate, And depreciation means it's going down in value, right? Something going down in value, depreciating.
Okay.
So it's really a almost theoretical tax deduction because your property is probably going up in value, right?
Sure.
When you buy it, you're hoping it's actually appreciating, it's going up in value. Nevertheless, the IRS gives you a deduction as if the property was actually going down in value. So they gave an arbitrary number called of 39 years, and they said a commercial property depreciates over 39 years. That means from the day that you buy it, not from the day it's built, well, unless you're, newly developing it, of course, then it's the same thing. Developing it or buying it is the same thing. From that day, you have 39 years that this building, so to speak, lasts for, or at least has a tax or a useful life, okay?
Gotcha.
Now we understand stuff, right? You buy, a car, it has a useful life, okay? And the day you drive it off the lot, it goes down in value, even though intrinsically it didn't go down in value, right? From one block to the next. But the IRS gives you a tax deduction. So they say, take that purchase price, okay? Divide that up by 39, and now you have a deduction every year for the next 39 years, okay, called depreciation. And that's all depreciation is. So let's say you buy, it's pretty straightforward, pretty simple. Let's say you buy a building for $1 million, okay? So right off the bat, we have to take a little bit for land. We're separating that off. We don't depreciate. Land itself does not depreciate.
Sure.
So let's say 15%. Okay, that's pretty average, pretty standard. You're left with $850,000. Just simple math here, okay? Divide that by 39 years. It's about $21,000, okay? Just take my word for it. I did the math beforehand. Okay, so that means your depreciation deduction from your income tax is going to be $21,000 right off the top. That means if you make $50,000 this year from your property, right off the top, you subtract 21,000, you're left with, right, 29,000.
Okay.
And you are taxed on what's remaining. Okay, so as opposed to paying income tax on the entire 50,000 that you netted, you right off the top subtract 21,000, which is your normal deduction, and you're only taxed on the remaining $29,000. Okay, that's depreciation, but it gets better.
Okay.
Okay, and this is where cost segregation comes into hand.
There's
Unless
more. Okay.
wait, there's more. And I'm going to do that 2 more times. So it's like I'm just building up, right? You have so that's all commercial properties. Just as a side note, residential properties and multifamily, for anyone listening here, is on a 27.5-year schedule. Okay, I don't want to get too confusing because we're talking self-storage. Self-storage is commercial, 39-year schedule. That's the depreciation life. Just wanted to put that out there for anyone that may be listening that also invests in multifamily or a residential. They would want to know that as well.
Got it.
And it's going to apply to them and everyone across the board. Cost segregation means the IRS put in the tax code a way to actually break down the property or segregate the property into different assets, different actual pieces of the building from a tax standpoint, and says that, yes, the structure of the building depreciates or has a useful life of 39 years, but there's actually more stuff that has a shorter useful life, either 5-year useful life or a 15-year useful life, which means you can allocate costs or you can allocate value to those different categories and therefore depreciate them faster, meaning take extra income tax deductions earlier on, front load those deductions if you were.
Okay.
So that's pretty much what cost segregation is. I'm going to break it down into what those things are, what those 5-year and 15-year categories, and how they specifically apply to self-storage, because every single property that's out there can benefit from cost segregation. There's just different stuff in the buildings that have different useful lives, and therefore, for self-storage owners, it would be very helpful to know what exactly is in your building that may fit into that category. So the first category is 5-year, which includes anything that's called personal property. Now, personal property doesn't just mean like it's movable necessarily, which we usually think of personal or tangible property. It does include anything movable. So like, appliances or furniture and stuff like that, or equipment. But in self-storage, you don't have much of that. So there's actually other stuff that's not really considered part of the structure, but nevertheless is still in this 5-year category. So that would include stuff like building mounted floodlighting. Okay. You'll have security systems. You may even have partitions in the, that are demountable or things like that. You might have certain equipment. There may be stuff in there. Or if you have an office in the self-storage property, like stuff in that office may have more of that equipment or furniture that goes in there. But even telephone or data systems, special purpose HVAC, if you have HVAC right in each unit, which a lot of self-storage facilities have, even the grills or the security doors, all of those are actually considered 5-year property, not part of the main structure. Okay, so all these things, and there's even more. These are just a few examples so that you can kind of wrap our heads around. This is stuff, yeah, hey, I can see. It's like attached, but it can be removed. It's not going to break down the building if I move it. And that's really where the concept comes from. Okay. Makes
more sense so far. So you're making things a lot more clear in my head already. So
exactly. And I'm just going to touch on to the 15-year category because that's a big one. And then I'm going to just bring it back and see, well, how does this actually work? Like, how do you do cost segregation? What does that entail? And how do I get these tax deductions? Because there is a process involved. So I'm going to cross the bridge in a second. I just wanted to explain the second category, which was a very big one, which is called land improvements. Okay. I mentioned before that land does not depreciate. So we're always going to have to subtract an amount from the actual purchase price, allocate to land, but there's something called land improvements. Land improvements means anything that's actually on the land that's not land. Well, that includes stuff like pavement, okay, concrete, landscaping, fencing, any retaining walls, signage, anything that's basically outside of the main structure of the property on the outside, if you have a chain link fence, all of that stuff is considered 15-year property, meaning it depreciates at a 15-year scale, a 15-year life. Okay, and there's even more stuff in there, like even stuff like like the stormwater drainage system. Okay, you wouldn't even think of it. You're like, well, yeah, that's the pavement, whatever. No, it actually has a different value than the regular concrete, right, or the regular pavements, right? The parking lot and the curbing have different values to it. Or if you have like parking, what do you call it? Like not just the pavement, but like those I'm just blanking on the name of it for whatever reason. There's parking blocks, right?
Okay, just parking stalls, you mean?
Yeah, exactly. Or like even if you have signs, like a handicap sign for the parking, right? That sign has a value to it. That's when you don't even think about it. When you start adding it up, okay, all of this stuff has value. Okay, so now we're gonna go a little further and see, well, how does this actually work? And then I'm going to throw in something even bigger, which is called bonus depreciation, which it's a big topic in the news since the latest tax reform a couple years ago. But it's huge, and you're going to see in a minute how this is going to be a huge game changer. So far, so good?
Yep. Nope. You're making things a lot clearer to me. So that's why you're helping me. And if I can understand it, yeah. That means most people can understand it because I'm not that bright. So good.
Okay. All right, Jim. So you need the catch is, right, that you need an engineer to do this, to find the value, find all of the values, all of these assets within a property and assign a value to them and create what's called a cost segregation study. And in order to do that, there's a whole methodology, there's a whole system, and you can Google it if you want. It's called the Cost Segregation Audit Techniques Guide. Okay, this is from the IRS. It's a guide of what needs to go into producing a cost segregation study on a property and how to actually follow all those rules to get, an end product or a study, which is similar to like an appraisal, but it's totally according to the tax code. Okay. So There are firms like ours, Madison Specs, where we have a full team of engineers who are specialized in this or trained in this, and accountants. We're not an accounting firm. We specialize in this service. So we'll send an engineer to the property, and that's a requirement, right? An engineer has to go and walk the property. They'll take pictures, measurements, et cetera, and they'll tell you how many square feet is that asphalt, that parking lot. How many square feet is the what's it called? The screen doors, the security doors, whatever. And they'll take account of every single unit, everything out there, add it up, create a very detailed report with all the calculations of what's the useful life, when was it placed in service, this property, and what is the industry standard value placed on that specific item, right? And there's a whole calculation involved in that as well. Produce this study, which will essentially tell you, hey, yeah, in your property, you bought it for $1 million, right? But about 10% of that is actually allocated to these, land improvements, which depreciates on a 15-year schedule. And another 10% or 20% is allocated to the 5-year property, all that stuff that's, all that equipment and partitions and whatnot. And it will be detailed in calculations, but they'll come up with a bulk number. So that means that $200,000 or $300,000 of that $1 million, you can now take those depreciation deductions in those first 5 years, right? Or first 15 years, which means we're front loading a whole chunk of them. Well, what does that mean? How does that translate into, how does it make a difference to me? Okay. So if you take our calculation before that we did, you made $50,000 from your property net. Okay. Mm-hmm. You were paying, you got the regular depreciation, $21,000. You're still left with $29,000 that you made that you're going to get taxed on. Now, if you're at a 30% tax rate or 35% tax rate or even higher, right? Some states, including federal and state, 43, 44% tax rate. Okay, guess what? You're going to be paying, cutting a nice check. And obviously, the greater the property, the greater the NOI, the greater the amount that you're taxed on, it's just multiplied. Exactly. And that's your money. Now we have to get out of this kind of concept that, we have to pay taxes. Okay. Now, you only have an obligation to pay taxes when you're required to pay taxes. But for real estate professionals and real estate owners who own self-storage or own businesses that are in the real estate, the IRS gives you special treatment. Okay, let's just face it, right? The president and the majority of Congress own real estate. Okay, so they're passing legislation to benefit real estate investors. Now, whether that's right, whether that's wrong, we have to, act on it and take advantage of it. And that's really what it comes down to.
That's the reality of it. So yeah, if it's being presented to you and you can take advantage of it, go ahead. Yeah.
The sad part is that most people don't take advantage of it. They think, well, I made this money, now I have to pay tax. And it's a common misconception. I've heard this from people over and over again. My accountant says, hey, if you're paying taxes, it's a great sign because it means you're making money. Right? You've ever heard that one before?
I heard it. Oh yeah.
But guess what? If you're in real estate, you're owning real estate, that probably isn't the case because you have these deductions. Let's get back to our $50,000, okay? You made 50 grand. That's great. You can pocket that. That's your money. You made that on your property. Right off the bat, they say depreciation, cut it down. You only have to pay tax on $29,000. Now, what if I were to tell you by doing cost segregation, we're going to front load $150,000, right, of that depreciation into the first 5 years? Well, guess what? That means an extra $30,000 of deductions over those each year for the first 5 years. That means you're going to cut down your $29,000 tax liability has now become a zero or a negative $1,000 tax liability, which means how much income tax do you have to pay? Zero.
Yeah.
Zero, nothing, which is incredible, which means you made $50,000 and instead of writing a check maybe for 10 or 15 of that to the IRS and left with 30, 40 or 35, you're left with all 50. Okay. And that's a basic high level picture of how conservation works and how you can maximize your cash flow.
No, it's found money. As far as I'm concerned, it's found money. Yeah.
It's your money, right?
Yeah, that's not, it helps out tremendously. quite frankly, coming into this, I've heard of it and didn't know what it meant. So no, thank you. You broke it all down and makes so much more, so much more sense. I'm just trying to think of
And dollars.
all the owners that I currently were in my circles of what I run. Yeah, they need to be checking into this like now.
Right. So the great thing about it is most companies, and my firm is obviously no exception, that will provide an upfront analysis, like an estimate on any property at no cost, no obligation, just to show you what your tax benefits would be if you went and did a full cost segregation study. Now, the study itself, there's a fee involved. It's a service provided. It's not contingent on your savings. So whether your tax savings are going to be $100,000 or $10 million, the fee is going to be the same if the property size is the same. So it usually runs between, somewhere between $4,000 and $7,000, depending on the scope of work that's involved, the size of the property, et cetera. But, just to tell you from our experience, we work with one of the largest self-storage REITs in the country, and a number, just one, that's one example, but we work with, dozens of self-storage owners across the country, helping them with this tax benefit. So all you need to do is reach out to me, and I can just take some basic information about the property and be able to produce those numbers so you can see what the tax benefit would be, versus what that cost is involved. And it's pretty much a no-brainer once you have those numbers.
Yeah, so you're just giving them the potential of what they could be saving or earning, however you want to look at it.
Exactly.
And they can decide if they want to move forward from there. But yeah, if it's kind of black and white numbers and they can see what they're going to be getting back, yeah, kind of like you said, it's a no-brainer decision.
Sure. So I'm just gonna. I know I don't know how much time we have here, but I'm just gonna throw out a couple more nuggets because
no, please. I'm loving it. So go.
We didn't cover everything, and believe me, I can go on for hours. But I try to condense this as much as possible. There is something called bonus depreciation, which is another one of those. It gets better. Well,
there's more. Exactly. Yep.
And this is not an infomercial. Don't worry. But you can dial right now. 1-8. No.
Exactly. This turned into like a StrangMail commercial all of a sudden.
It gets better. Look what I have here. Oh. So what you want to understand about the bonus depreciation, it's a very simple thing. Okay. The new tax reform allowed that instead of waiting, anything that depreciates less than 20 years, okay, which is everything we talked about in those two categories, that 5-year personal property or the 15-year land improvements. Yep. You can now, instead of waiting, accelerating that depreciation to 5 and 15 years, you can now take all of it in year number 1. Okay. So it's called 100% bonus depreciation. And it's like a huge boost, which, isn't beneficial for everyone, because if you don't have that tax liability, right, it's just, all it's going to do is cut down your tax liability to 0 and then create a very large passive loss. Now, passive loss means that you have negative tax liability, and that's not a bad thing. It just means you can't utilize it right now. What happens with that kind of imaginary bucket of, or like imaginary bank account of extra depreciation, it just gets carried forward. It moves with you to the next year. And if you can utilize the next year's tax, then you can, they can be pulled out, excuse me, and used. Or when you sell the property, that's when that's finally released and actually can be used at that point. So,
makes sense.
So it's not, but again, the bonus depreciation, it can be huge, especially when a person has like a huge tax liability if they're making a lot of money, and regular depreciation is not covering, to knock them down. And this is, kind of why is really the secret to why, real estate investors are not just making money, but they're, it's not about what you make, it's about what you keep, right? It's about how much you actually keep in your pocket. So this is one of like the biggest, it's not a secret, but it's one of the biggest strategies out there.
Yeah, I said it's not because it's a secret, but it's a strategy that I don't know, quite frankly, gets across to many people, Like, going back to the beginning of the show, we were talking, they just kind of figure out my accountant they'll let me know. They'll let me know what's up to, that's what I pay them for. They'll tell me what I can do. Well, sometimes, more often than not, they don't.
Yeah, believe it or not, that's part of the problem. I mean, people assume that it's tax related, so I don't want to talk about it, I don't want to hear about it. My accountant deals with that, but the truth of the matter is, this is something that an engineer needs to do. So your accountant is going to, unless you work with like a huge accounting firm, right? Some of the big 4 or the big 10 accounting firms, they'll have cost segregation engineers on staff, right? So that they can do this. But the majority of people are not that, right? You're not like a Fortune 500 corporation, right? So you don't have one of those accounting firms as your accountant. So for the rest of us, we assume our accountant's going to take care of it. They're not. I mean, for the most part, they're not. I mean, I literally have relationships with a number of accountants. I mean, we work with hundreds of accountants across the country that actually are proactive and will refer their clients to us, to show them, here, this is something you can use.
Yeah.
And I have one accountant I just, spoke to literally yesterday up in Washington, and he's like, Yonah, I wish I'd have something, but all my clients, they're taking the proactive route and they're getting it done, without me having to say anything to them. So that's, that just goes to show you, he's not pushing them to do it because they're doing it on their own. Now that's, gives a great, kudos to those people for taking that proactive route. But at the same time, it just goes to show you that the accountants are not proactive on it. And this is a real estate accountant. He understands it. He gets it. And he's still not pushing it.
Well, hopefully with being on this and being exposed to people in this industry, hopefully they can be proactive and reaching out to you, and at least you can get the ball rolling and get some more information. Because I know there's plenty of storage owners that are, they listen to this podcast either today, tomorrow, next year. It's going to be out there. So they've been listening to this and they realize I need to get some more information to get the ball rolling. How do they reach out to you?
So the best way to find me is on LinkedIn. That's a great way to find me. I'm pretty active there. LinkedIn, Bigger Pockets, they're great places. But you can reach me in my email. You can probably put it in the show notes. Is my name, Weiss@madisonspecs.com. So the first letter, my first name, last name at Madison Specs. My phone number is 732-298-9002. That's my direct number. Feel free to call if you have any questions. And again, you want that free analysis, that free estimate, just to see what it would look like. It's a great, discussion point to have with your accountant.
Perfect. Like I say, give me a call, get in contact with you, to get the ball rolling on getting that free, analysis, and then go from there.
Exactly.
Well, perfect. Well, good. Well, thank you so much for taking the time. I learned a lot, so I know people that are listening to this, they learned a lot too, and they can take the next steps.
Awesome. Well, I appreciate you reaching out, Jim, and it has been a pleasure. And wish you the best of luck.
You too. We'll be in touch. Thanks, Jonah.
All right. Thank you.
See ya.
Thanks for supporting the show. I want to let you know that we've just opened up our brand new free private Facebook group. There I'll be having some extra special content not found anywhere else. If you really want your facility to be a success in today's market, then this is going to be the place for you. You can request to join us at selfstoragecommunity.com or search for Self Storage Domination Community on Facebook.